G'day everyone, my name is Mitchell Sneddon and welcome to another live InvestSMART webcast. What we'll be going through today are a series of different managed investment structures. So from say separately managed accounts, managed funds, listed investment companies and exchange traded funds. And as we go through those, we'll tell you what you need to know and what you need to look out for as well. And as we go along, of course, this is a live presentation, and the purpose of doing it live is to allow you to ask the questions that you want answered as we're going along. So just below the little box with the video in it, you'll see a section there where you can submit your questions. So as we're going along, please submit your questions, and hopefully I'll be able to get through all of them as we finish up at the end here. If I can't, I will definitely make a point of replying to your question in the form of an email. So do jot down your email address if I can't get to your question. But of course, as we get started here, the very first and most important slide that I put up in every single webcast and presentation I do is the disclaimer. So we'll be talking about investment products here, managed investment products and passive investment products. And of course, I do not know your personal circumstances. So please take that into consideration. This is general advice only. Especially as we get into the questions, because who knows, I could be talking about some specific funds or talking about some specific investment vehicles. And so just remember, this is general investment advice only. So as I said at the absolute top, the agenda here today, we're going to go through managed funds, separately managed accounts, listed investment companies, and exchange traded funds. And we'll go through the pros and cons for all four of those structures, how they work, and what you need to know before you go and invest in those. So you can invest in one or two or just one of these, or mix and combine them together to make a portfolio for yourself. But of course, certain types of structures are going to suit certain types of investors down their investment journey. So something that's suitable for me personally now in my 30s might not be suitable for someone in their 70s or 80s, depending on your income needs, etc. So that's what we're going to go through today. As I said, submit your questions as we're going. So the next slide here is just a little quote that I got from actually speaking with one of our analysts and talking about stock picking and talking about people getting started investing in the market. And what he did say to me was quite interesting, and so much so that I thought I'd put it up here on a slide. It basically says, if you are going to start picking individual stocks in the market, you are saying to yourself, whether you know it or not, that you have an edge and will be going to try to outperform the market. Okay, so by hand picking individual stocks, you're saying to yourself, I can do better than the market. Now, for those people who don't want to, say have limitations on their knowledge or their time, etc., they might go for a passive investment style approach where they get someone else to pick those stocks, or they just invest in an entire basket of stocks like an exchange traded fund. And that's why we're going to take a look at today. Now, this next slide here, a little while ago, I did a scan across Morningstar, and why it's important to know all the different structures because there is plenty of them out there, and they're all doing different things. They're invested in different asset classes, so equities, international equities, property, fixed interest, etc. And this is why it's important to know what they do and how they work, because there's over 9,000 managed funds listed on Morningstar right now available to Australian investors. There's over 151 exchange traded funds, and that sector is growing rapidly. I wouldn't be surprised if my little bit of information here on that is completely out of date by even now, even though that number was just accurate as of a couple of months ago. Then there's 93 listed investment companies. Now, I know that number's wrong because there's been a lot more recent initial public offerings for listed investment companies come onto the market. So there's this space of managed and passive investments is only growing, and so it's important that you know your way around it. So let's get into managed funds first. So this is probably the most common type of investment. They've been around for a very long time. A lot of people are very familiar with them. So a managed fund operates as a unit trust. It's an open-ended structure. What an open-ended structure means, and when you read it, in product disclosure statements and whatnot. It means that funds can come in. So if you want to invest in a managed fund, you'll transfer cash into the managed fund. And so, but as well, if you want to leave the managed fund, they'll transfer your cash out to you. So money can flow in and money can flow out. We'll come back to that point because it could be a bit of a negative when it comes to managed funds. Now, managed funds can also be listed, but they are predominantly unlisted. So you would have seen recently a lot of listed managed funds coming onto the market. The ASX has their own M funds section, which is basically managed funds, and instead of you applying directly with the fund manager for units, the ASX creates an exchange. So you buy the fund code on the ASX, and then the cash goes into the fund via that channel. Now, just like you would do with a standard managed fund, but of course you're not submitting any paperwork. So they are becoming more popular, but still by far the standard old managed fund where you have to submit your paperwork is the most common. Now, typically managed funds are valued daily, so that's where they issue their unit price of the underlying value, or the net asset value as it's often called, of the fund. Now, why this is important and why it's important to know when the fund is unitized, so when they do the calculation of the unit price, is because that is when you can apply for units and redeem units as well. So if it's done daily, that means you'll be able to send in an application and it will be done the following day. If it's done weekly, which can be the case with some unit trusts, you will put in, say it might be unitized at midday on Friday every week. You put in an application form, say on if you miss midday on Friday, if you get it to them by 2 p.m. on Friday, you'll be waiting to the following Friday. So that's just, and the same goes for when you're wanting to redeem funds as well. So just know when it's unitized, daily, weekly, or in some cases even monthly. So that's something to keep in mind. Now, with a managed fund as well, typically they'll report to you on a monthly basis. They might tell you the unit price on a daily basis, but they'll give you commentary in a monthly update where they'll give you generally, say, the 5 or top 10 holdings in the fund and give you a bit of commentary around it. Then on a quarterly basis, typically you'll see managed funds give a bit more color around the portfolio as a whole and maybe talk about some themes that they're investing in, etc. So now moving on to the pros and cons. The pros of investing in a managed fund are you get instant diversification. So as soon as you buy one unit in that fund, you're buying every single stock in that portfolio. So just from holding one managed fund, you might be able to hold in a concentrated portfolio, say you might be holding 15 to 20 equities. In a vast portfolio, you might be holding 100 equities. Now, of course, you get the benefit of a professional manager. This can be a benefit, but it also can be a negative because that manager might outperform, that manager might underperform. So you need to actually pick how a specific manager, you need to back that manager to hopefully perform for you over the long run. There is a large variety of investment strategies as well. So there is so many different managed funds out there. So there's something to suit everyone. If you like technical trading and you subscribe to a charting philosophy, then of course there's going to be trading funds out there for you. But if you're like us and say subscribe to a value investing approach and a long-term fundamental investment approach, then there's fundamental value investing funds out there for you as well. Now, another pro when it comes to managed funds is that they always trade at their net asset value. So you don't have to worry about not getting what your units are actually worth. And this is something that we'll talk about later on when we compare a managed fund to a listed investment company. And then, of course, it provides some simplicity when it comes to tax reporting. So with a managed fund, it's a pooled investment, and so you'll just get a one or two couple of pieces of paper, a nice, neat, simple tax report. Typically, a managed fund, the tax reporting can come out relatively closely after the end of financial year. It depends on what they're holding, of course. If it's holding, say, Australian real estate investment trusts and property trusts, you need to wait for those trusts to report to the fund first before they can get the tax statements out to you. But typically speaking, if it's a plain vanilla Australian equities portfolio, then they should have that tax reporting, that tax statement out to you relatively promptly. Now, when we come to the cons of investing in a managed fund, you've got to remember it's a pooled investment. So you do not own the underlying stocks, okay? And so that creates a couple of issues in certain places. Of course, it's because it's not tax efficient, which is the last dot point there. In a pooled investment, you're all members of the same pool. And say, for example, if I came into a fund at the 1st of June, and prior to that, the fund had done 10 or 20%, but then for the month of June, it was flat. I haven't been a unit holder for that past period of time. I have not enjoyed the benefit of those returns, yet come tax time, because I'm a member, I'll need to pay my share of the capital gains on that. Now, the open-ended structure, we've come back to this. I believe it's a con because, generally speaking, cash can flow in and flow out whenever the investors like. Now, of course, fund managers don't typically mind it when cash flows in, but they might mind it when it flows in and it's not the right time for them to buy. Now, because what I mean when I say that is because, generally speaking, when people are happy to give you plenty of funds, when they're optimistic about the stock market, it's generally not when there's plenty of red on the boards. It's when the stock market has had a good run and everyone's talking about their superannuation returns, everyone's talking about stock tips, etc. It feels good to be an investor. That is typically when the most amount of inflows will come into a managed fund. And that is when, especially a value manager, can actually least deploy those funds. Okay, so they can actually be a bit of a drag on the performance. On the inverse of that, when you receive the most amount of redemptions, that's typically when no one wants to talk about the market, when there's plenty of red on the board. For a lack of a better term in the industry, they call it when there's blood in the streets, and that is when most amount of funds flow out of a managed fund, and that is when, especially a value investor, can be actually buying. That's when they want to buy. So the time when they want to buy the most is when unit holders are actually leaving. The time when they want to buy the least typically will be when unit holders are coming in. So it is a very tough thing for fund managers to control. Also, you got to keep in mind when you're redeeming units, the fund manager can be, if they don't have enough cash on the books, a forced seller. So they'll have to sell down stocks to pay you out, and that can impact people negatively if they're remaining in the fund. Now, you cannot transfer stocks in and out as well of a managed fund, so it's just cash in, cash out. So if you've got a portfolio and you're looking to hand the reins of that portfolio across to a fund manager and they manage a unit trust as typical managed fund, then you're not able to transfer your stock into that. Even though they might hold, say, a lot of the similar stock, you have to transfer in cash. So it's cash in, cash out. Just keep that in mind as well. So what to consider when investing? One thing that I always look for, because fees come up a lot in the managed product side of things when you're talking to people, check the product disclosure statement if they're charging a performance fee to see if there's a high watermark. And they'll be the exact words that should be in that product disclosure statement. What a high watermark is a mark that basically if your portfolio gets, say, 10% and they charge you a performance fee to get you that, then the following year it drops back, then the next year it gets you back up to 10%. If you do not have a high watermark in place, you'll pay that performance fee again. Okay? If you do have a high watermark in place, they need to get you back to the highest point that the fund got and then exceed that and then they can only charge a performance fee on what you've exceeded the high water mark by. So just keep that in mind. It just helps you so you're not getting charged twice for performance fees, because performance fees can and do hurt. Understand the investment strategy, really, really important, because if you don't know why you're invested in a fund, you don't know why the fund has gone up, and inversely, you won't know why the fund has gone down. So that's really important for you to be comfortable, because you're not getting total visibility over what's going on in the fund as well. You just remember getting that unit price moving around, and you're getting the top 5 or 10 holdings. So you have to be comfortable with the investment strategy and be familiar with it. And then, of course, be aware of your income requirements. The reason why I say that is because a managed fund will typically pay 2 distributions a year. Some of you might require more income than those 2 distributions a year. If you do require more income, then you might be forced to sell units, and a lot of people don't like to do that. So just keep in mind your income requirements when looking at a managed fund and when they pay out their distributions. Okay, so moving on to separately managed accounts. These are a term that they're picking up speed at the moment. A lot of new managers are starting to use separately managed accounts. We've been using them for a couple of years now here at InvestSMART. People can invest in our InvestSMART separately managed accounts. We also have our 2 intelligent investor portfolios that are run as separately managed accounts. So that covers off the very first dot point here. They are managed by a professional manager. They're managed to a model. So for example, we have our ideal selection of stocks right now in our intelligent investor portfolios. We will have certain percentages for the weighting. So for example, say we have 6% CBA, 5% TPG, for lack of a better one, and 4% BHP, etc. So when you come into the separately managed account, we'll line up your portfolio, which can be stock or cash, and we'll compare it to the model, and then we'll go out and do transactions to bring it in line with the model. So with a separately managed account, it doesn't matter if, say, you've only got 10 grand or 10 million, you'll end up with the same percentage allocation of stock. Now, when that manager goes out there and actually says BHP has run and it's become 9% of the portfolio rather than just our original 6%, and we want to trim that back, they might trim that extra 3% that it's gained. And what that'll do, if they do that on the model portfolio, what that'll do is trigger transactions across all the portfolios, all the clients' portfolios who are following that particular model. That's how it works. So you actually own the underlying shares in a separately managed account as well. So you are the actual beneficial owner. The shares are held in trust by you by a custodian. Trust for you by a custodian, I should say. For ourselves, we use HSBC. So what that does is, in case anything happens to, say, InvestSMART or the manager of the model portfolio, your stocks are your stocks. They're completely separate from the company, and they're held in trust for you. So nothing will actually happen to your stocks. You own shares and not units. So that's another issue. That separates it from what a typical managed fund is. So I believe we've covered off the last point there as well. Transactions are based on your selected model portfolio, and you don't just have to have one. You could have an international model portfolio in your separately managed account. That is a part of the same separately managed account. You could then have Australian portfolio as well in there by the same or a different manager. So just keep that in mind when you're looking at a separately managed account. Now, the pros and cons, there's 100% transparency. You see all the trades and all the stocks. So with us, with our intelligent investor models, you'll actually get to see the highest weighted stocks and the lowest weighted stocks. We actually take the transparency level a little bit further. You're actually able to click on the individual code and then go through to all of our research and know why that stock is in the portfolio. There is nowhere to hide with a separately managed account. You'll see all the dividends and income that come into your portfolio as well. And that leads me into the next pro about a separately managed account. It's flexible ways to receive income. So we have one of the reasons why we've selected this as an investment vehicle for our portfolios is because we have a large range of clients, all with different needs. And so a separately managed account gives those clients the flexibility that they need to tailor their income stream for their specific requirements. Now, what I mean when I say that is, say, for example, you can actually have the dividends as they're paid and the interest earned on any cash swept into an account of your choosing. So as and when they come in, they get swept out. Now, that's completely different, of course, to a managed fund, which will pay you 2 distributions a year on set dates. For us, you can have it swept into your account as and when they're paid. Now, secondly, you can actually set up a monthly drawdown. So if you need $4,000 a month to live off for your living expenses, then we can have that swept out into an account of your choosing as well. If you don't have such rigid requirements and need a more ad hoc style, then we can adjust that. You can send in requests and draw down as and when you need, whatever amount you need. Then you can combine all 3 as well. So you might have a regular monthly drawdown plus the income sweep coming in. So it's completely up to you how you want to structure it. So that's why an SMA is really good when it comes to flexibility of income. Now, of course, you get the full beneficial ownership of the underlying stocks. So you get, of course, the franking credits that come with all the dividends. As well, you do get to, if for some reason you wanted to leave the SMA structure, you can choose to take those stocks with you to another broker. If you say you're opening up a CommSec account because you're going to start doing it yourself, or an E-Trade account or NabTrade, whoever it is you're with, you can actually transfer those stocks because you own them out into that account. So that's something to keep abreast of. Greater tax efficiency because basically you're in your own portfolio. Your portfolio is your portfolio. The next person beside you, they might be linked to the same investment model, but their stocks are their stocks as well. You're completely separate from everyone else, and they're quite cost effective as well to run. So for example, our brokerage, because our clients do pay brokerage on these accounts, it's a settlement fee of 33 cents per trade, and then 0.05% of the transacted value. So really, really cheap to run, especially if you do those figures on, say, a $10,000 trade. You know that's pretty cheap. Now, the cons, you cannot exclude specific stocks from an investment model. If the stock is in a model, it's going to be in your separately managed account. Okay, so that's something to keep notice of. You would need to then look at if there were certain stocks that you didn't want and you wanted to exclude them, or if you transferred in stocks and you wanted to put a hold on one and not have it sold, etc. What you're looking at there is a next level up from a separately managed account, which is an individually managed account. And basically that, of course, comes with a higher cost of running it or a higher barrier to entry. So they're typically a wholesale product, and you need a fair bit of cash to be able to open up one of those. And there's less paperwork for tax than holding direct equities, but slightly more paperwork for tax when it comes to holding, say, a managed fund. Because you do actually own the underlying equities in the portfolio, you're going to get a little bit more paperwork at tax time, but nowhere near as much as if you just held those equities directly outright on your own. What to consider when investing? I touched on this before. Does your SMA allow you to invest across multiple models? For example, with us, you can blend our international with our Australian equity growth portfolio, or vice versa, whatever you want to do with any one of our, I think, 9 investment models we currently have. Are you paying platform fees as well? So typically a separately managed account will be offered through a platform. Now, a platform is like, say, Macquarie Wrap or BT Wrap or one of those providers, and you'll pay a platform fee, then you'll pay the underlying management fee as well of the model portfolio. So that'll eat away at your returns. So just keep in mind if you're paying a platform fee. For us, when you're investing in InvestSMART separately managed accounts, there's no platform fee. It's just the underlying management fee. And then, of course, what are those management fees? Make sure they're reasonable and not too excessive. For ourselves, we start for the InvestSMART portfolios, we start at 77 basis points, so 0.77% per annum, and then they go down. For the intelligent investor managed portfolios, they start at 0.97% per annum and come down. And just a note there are no performance fees associated with those portfolios. And which is my last dot point there. If there are performance fees associated with a SMA that you're looking at, do make sure that there's a high watermark in those performance fees, terms and conditions. Now, exchange traded funds are growing in popularity, especially amongst self-directed investors, and growing as an investment category in general, and it's changing a lot as well. Typically, when I say exchange traded funds, especially say a couple of years ago, all I was thinking about was those stock standard index tracking exchange traded funds. So for example, SPDR, which is the State Street ASX 200 exchange traded fund, that is what I would typically have thought of. Now we're seeing a lot of different exchange traded funds coming onto the market, ones that track an index of their own creation, a lot of rules based ones. So it's becoming a really interesting and fascinating space. So I've just gone over the top dot point there. They are index tracking. They will track either an already existing index or they will track one of the issuer's creation. They are similar to a standard managed fund. So basically you've got a fund manager there investing a bucket of capital, okay? And as you buy units on the market, you become an investor in there and the cash flows in. As you sell units on the market, cash comes out from the underlying fund. They can use a lot of different investment strategies, and more of these are coming onto the market, so make sure you actually understand the underlying investment strategy. And so they have the actual mechanics of how it works underneath. There's things called market makers. They buy and sell units to create liquidity. So typically an ETF will be very liquid. You'll be able to go in and out of it quite easily, but just the liquidity concerns more kind of come up around what the underlying exchange traded fund itself is invested in. If it's an ASX 200 one, then of course you'll be able to move in and out fairly easily, and the market makers will be able to move in and out of the stocks fairly easily as well. This is why you typically won't see too many exchange traded funds with smaller caps in them, because the liquidity of the underlying portfolio is nowhere near as high, and therefore if unit holders or trying to buy in and out, and traders are trying to take advantage of it, then you might have liquidity issues. So that's why you don't tend to see too many small cap focused exchange traded funds. So the pros and cons, you get instant diversification. So as I said before, say if take for example the ASX 200, you get all 200 stocks in the ASX. So what you're removing there is company-specific risk. What you are maintaining, of course, is market risk, but you are removing the company-specific risk. These are typically low cost and give you access to global markets. So I believe there is an exchange-traded fund domiciled here in Australia that, it's domiciled in the US from iShares that invests in the S&P 500. It's got a management expense ratio of 0.04% per annum. So I don't think you'll ever find anything lower than that. And of course you can use exchange traded funds to invest in very specific themes. If you want to invest in global healthcare, there is a ETF out there with the ticker code of drug. That'll give you exposure to global healthcare. If you wanted to invest in global cybersecurity, for example, you can do that. There's one out there called HACK. If you wanted to invest in agriculture, there is an ETF out there called food. So, and if you want to invest in the Australian dollar, or if you want to invest in the market going down, there's ETFs out there for you to be able to do that, and there's only more coming onto the market. And so These are great ways to create low-cost, multi-asset class portfolios. And that's what we've done as well with our InvestSMART portfolios, our InvestSMART growth portfolio, our InvestSMART diversified income portfolio. These use exchange-traded funds for a low-cost, broad-based asset class exposure across the globe to give you a suitable return that is generally a couple of percent above the RBA cash rate. That's what we're looking to achieve depending on the individual portfolio. The cons, when it comes to investing in an exchange-traded fund, someone once asked me in what circumstances they will outperform, and the answer is never. They will never outperform the benchmark that they're tracking because simply it will, if all things are being equal, it is designed to track the index perfectly minus the cost of the fees. That's exactly what it's designed to do. Now, you will hold the good, the bad, and the ugly in these exchange-traded funds. And so there's, yes, if you go and buy an ASX 200 ETF, then you're holding all 200. Now, there's maybe only a handful of stocks in there at any one point in time that we, as the Intelligent Investor Analyst team, would be happy to actually be holding. And just because the company's big doesn't mean it's good. Also, you could be holding plenty of overvalued stocks as a part of that indices as well. So just keep in mind when you are taking out company-specific risk, you also are leaving yourself open to holding a basket of good, bad, and downright ugly companies as well. So things to consider when you're looking to buy a exchange-traded fund. Of course, focus on fees and size. As I said, all things being equal, your portfolio, the index that you're tracking, that fund will underperform the index by the cost of the fees. Be wary of tracking error as well. This will show you how accurately your chosen exchange-traded fund provider can actually track the underlying index. And now be mindful of smart beta. The reason why I say this is because there are a lot more ETFs coming onto the market, some promising to do a lot based on a certain set of rules that have been, say, put in place from a lot of historical back testing. A lot of that has been historical, and for us, I don't think there is one set formula to an exchange-traded fund or one set formula when it comes to investing in the stock market where we can run that formula over a bucket of stocks and come out with the absolute best, because what that is doing is it's actually using a formula and using data from yesterday or last year's data. And companies change, companies are fluid, the market's fluid, and for us investing is maybe perhaps more of an art than a science, especially if you are choosing or handpicking individual stocks. So just be wary of that when looking at these. We do prefer just to get passive ETF exposure using, say, the ASX 200 ETFs and our international ones tracking very specific indexes because we want that average long-term return from those. Now, the last one that we're going to take a look at is listed investment companies. Now, listed investment companies, which is often shortened to LICs, they are a closed-ended structure. So what that means is basically they'll raise the capital once, then they'll lock it into a company structure. So unless they do, they return capital to investors. The only way that you, as an investor, can get your funds back out of a listed investment company are by selling it on the market to another investor. So basically, you are not getting your capital back out of a listed investment company if you've participated in the initial public offering. So to buy in and out, you need to buy shares on the market, just like any other company. Now, the one thing to keep in mind with these that they can trade above and below their net tangible assets, so their actual value of the underlying portfolio, as opposed to a managed fund or a separately managed account or an ETF, where you will always get the underlying value of that portfolio at any given time. A listed investment company can trade dramatically higher or dramatically lower than its actual underlying value. So that's just something to certainly keep in mind. Then you get ones that are also internally managed and externally managed. So internally managed means that listed investment company employs its own investment team, which typically will significantly reduce the costs to an investor. And externally managed the listed investment company will give a mandate to a funds management company to manage that portfolio. Now, typically those will have a 1% plus management fee and also a performance fee associated with it. So the management expense ratios on externally managed listed investment companies are much higher than the management expense ratios on internally managed listed investment companies. So that's just something to keep an eye on, because fees will eat away at your return. Now, what I like to look for and what I focus on, no matter what the underlying manager tells me to focus on, is the total shareholder return. That is what ends up in your pocket at the end of the day. So the pros and cons of listed investment companies. The portfolio can be positioned with a long-term view in mind. Because it is a locked-in pool of capital, shareholders can come and go, but that capital is there to stay. And so what that gives is the manager the chance to really lock in a long-term investment plan, and they don't need to worry about cash flowing in or out of that portfolio. There are numerous investment strategies, just like ETFs, just like managed funds, and just like separately managed accounts. So, of course, choose one that you're comfortable with. As I said, they can trade at a premium or a discount to their net tangible asset, so the actual underlying value. When it trades at a discount, it can be an opportunity to be able to buy that portfolio cheap, or it might not be. Okay, there's a lot of LICs that trade at a discount and never ever close that gap from the share price to the net tangible assets. On the other side, you will potentially get the opportunity to buy something cheap and sell it for more than what it's worth. It's like buying a dollar for 80 cents and then selling that dollar for $1.20. That in the ideal scenario. Now, of course, in the ideal scenario very rarely plays out in the investment world. And now the other big important thing is that an LIC is a company. So that word company in the title of it really tells you a lot about what it can do for income. Now, a managed fund and an ETF will pay out all income earned or realized income for that year. A listed investment company doesn't have to do it. Because it's a company, it can actually retain the earnings and look to pay them out at a later date. So what that can do is they can smooth out the dividend payments to you as an investor. So for example, if you look at the likes of AFIC, Argo and BKI over the course of their history, you can see ever increasingly small little dividend payments going up year on year. Almost never have they actually decreased that dividend payment. So that's something, of course, that's very important to a lot of investors. Now, on the negative side, the closed-ended structure can be a negative. Basically, the reason why I say it can be a negative is because once that fund manager has got the money, they're charging fees on it. They might not exactly have a lot of incentive to spend money on things that are more tangible, or intangible, I should say, like marketing. Communication and marketing of a portfolio does actually go a long way to keeping that discount to NTA nice and close. So not only is it performance and paying a nice dividend, but communicating effectively to the market. So once you've raised that money, the incentive to get out there and continue to communicate, especially if that communication costs money, is maybe going to decline a little bit. Now, fees can be high and not overly transparent. Now, not a lot of people go through listed investment companies and exchange-traded fund and managed funds annual reports. But if you were to do so, that's where you'll find all the ins and outs of the actual performance fees and the expenses. So if you want to really see what you're paying at the end of the day, go and check out the annual report of a listed investment company or an ETF. Yes, they are boring to read, but there's everything that you're paying will be listed in there. Now, a lot of the listed investment companies coming onto the market have got relatively small market caps. There is a lot of listed investment companies that are sub 100 million in market cap. And of course, what that does is create illiquidity, and they can be very difficult to buy. They can also be very difficult to sell. So they trade at very low volumes, and that is something that you really do need to be aware of before looking at these to invest in. So what to consider, of course, when it comes to investing in a separately managed account, a managed fund, or a listed investment company, do invest in an investment approach you actually understand, because as I said before, when it goes right, you want to know why it's gone right. When it goes wrong, you want to know why it's gone wrong. Buy at a discount to net tangible assets. This will vary depending on fees as well. For example, if I'm buying into something like BKI, which has got a management expense ratio of 0.14% per annum, I'm buying at not too great a discount. I don't need to see a huge discount to be able to buy that. If I'm buying into something that charges 1% plus performance, etc., I'm going to want to see a 10% plus discount to net tangible assets before I look at buying into it. Be mindful of options. A lot of listed investment companies, when they have their initial public offering, will issue bonus options or some form of options. That'll act like a ceiling on the share price before they're removed. And they also create a secondary market for people to invest in as well. So you might not get a true reflection of the performance. And of course, that ceiling will be a bit of a stopper for the share price initially. Now, also keep in mind, and this goes for all types of investment products, are the managers actually invested alongside you? Now, this is really important because you want a manager who invests the money like they'd invest it themselves. There's no greater way of seeing that than them actually being invested alongside you. Now, with a listed investment company, you will be able to see the top 20 shareholdings. Hopefully, the manager is alongside you there in the top 20 shareholdings. I know here, if anyone is wondering, a lot of our staff, we invest in our own separately managed accounts with the company. And I know coming up, we are launching a small cap fund very shortly as a managed fund. And I know the managers of that fund also will be investing in it as well alongside our investors. Now, also, last thing to consider when looking at a listed investment company are the dividend reserves. Now, this is the retained profits. How deep are they? Because that is what your future dividends are going to come out of, especially if they have a few leaner years. So just see what the cover of the retained earnings are there to cover off this year's dividend and a couple more down the track. So that brings me to the end of my actual formal presentation. I'm now going to jump out of the PowerPoint here and go into your questions. Just before I do though, I did want to say that coming up on this Thursday, we've got another live advisor Q&A hosted by Tony Kay, the editor of the Eureka Report, and our two resident advisors, Bruce Bremmel and Max Newnham, talking about tax and superannuation. So do send in plenty of questions for those guys there if you have any burning superannuation questions. And then on Monday, the 21st of August, so this coming Monday, Tony Kay is back in the saddle again with Nerida Conisbee and Cameron Kusher, and they're talking the property outlook. So that's live as well, and you'll be able to ask questions as we go along there. So that's both two things to keep an eye out for. Now, I'm just going to jump out of the presentation and see if there's been any questions coming up here. Now, I'm just going to publish a few because we have had quite a few come through. So, okay, let me see here. We've got a couple of questions coming through here. How frequently, Ian asks, are separately managed accounts rebalanced? That depends on two things, Ian. Basically, they're rebalanced when the manager sees fit. For example, if we want to rebalance the intelligent investor income equity portfolio, then of course the intelligent investor team, if they think they need to trim a few stocks here and there and add to a few others, then they'll do that. And that will be at an ad hoc basis when the investment committee believes it requires doing. The other portfolio, and then of course the second component of that is when a client either puts in funds or takes out funds. So if you have a portfolio of say $100,000, it's invested currently, and the cash balance in that portfolio is in line with the model, and say that cash balance in the model is 5%, you go and put in another $100,000, then that cash, and that comes in as cash, that cash balance is going to then increase dramatically compared to the rest of the model, rest of the portfolio. So what that does then is make that cash allocation incredibly high as a percentage. All the stocks go down incredibly low, and so therefore we go out and we buy stock to reduce your cash weighting and to increase the stocks as a percentage of the portfolio. So that's when the weightings, re-weightings happen, or the rebalancing happens. With our InvestSMART portfolios, so the growth and say the income portfolio there, our investment committee will meet, then they'll decide whether or not they need to rebalance, say, certain areas. So ASX 200 exposure, international exposure, property exposure, fixed interest exposure. They'll decide to rebalance there. And then, of course, if people have the dividends coming back into the cash component of the separately managed account, they'll get rebalanced as that pushes up the cash weighting, and therefore naturally decreases the weighting in equities. Then we'll go out and purchase more equities with that cash. So I hope that helps. Now, which investment slash funds models would you recommend for a person in their 30s as opposed to a senior? Thanks for that question there, and it's a really good question as well. There has been a study actually done recently by the ASX which shows that most younger people are actually very conservative when it comes to their investing, which should really be the opposite. Because you've got the longer investment time horizon you've got, the more exposure you should have, as a general rule of thumb, to growth assets. Now, growth assets are Australian equities, international equities, and property. So if you've got a large portion of, say, a balanced fund, and you're in your 30s, and that balanced fund is in a large portion of fixed interest in cash, you actually should, of course, I should put the disclaimer up here, this is only general advice as well, but it tells us that you should be putting having more of that cash in higher growth assets. So do look for something that is less cash and fixed interest in those defensive asset classes, and something in more of the growth asset classes if you plan to have those funds invested for a long time. Now, I believe that is all the questions that we've had come through. So a really quiet crowd today, but do join me next time. Keep an eye on the events section, and join me next time and ask plenty of questions then. But in the meantime, my name's Mitchell Sneddon. Thanks for joining me, and we'll catch you later.